Welcome to the Trepp case Distressed Borrower Roundtable hosted by REFI TV. I'm Samantha Rowan, the editor of Real Estate, Finance, and Investment, and today we're going to be taking a deep dive into some of the situations that are making it difficult for some commercial real estate borrowers to refinance loans. Our panel today consists of Kevin Donohue of C3 Capital Partners, Ira Zlotowitz from Eastern Union Funding, Linda Aronson from JLL, Joe McBride from Trepp, and Shlomo Chopp of Case Property Services. Thank you all for being here today, and let's get right down to it. Linda, does JLL do a lot of work with owners with underperforming properties? And in your experience, how many of those situations are property-driven and how many are borrower-driven?
We do a tremendous amount of work with distressed properties, and the majority of them are really driven by the higher vacancy rates that were not anticipated when the underwriting was initially done. So what we're seeing is the borrower winds up in a position where they've got higher vacancy rates than expected. They've got lower rental rates than they had were included in their underwriting. And so as the property manager, our focus is really on trying to maximize whatever revenue we can, minimizing expenses to the extent that we can without ever sacrificing service or safety or quality or any of that. And then really looking at long-range planning to help those borrowers, our clients, manage through that process. And very often, those properties then transition back to the lender. And then our role is to maintain that and really focus on, again, maximizing what revenue there is so that they can either work out the loan or that it will transition to a successor to the borrower.
Well, and JLL has a lot of strength just in terms of purchasing power, right? Because you do it on such a large scale.
Absolutely. So one of the things that we can do in terms of managing the expenses is really leverage our buying power. So as a rule, we can buy, and as an example, I'll just say toilet paper, a lot cheaper than an individual owner, or in many cases than a small janitorial provider. So we can leverage our buying power, we can leverage our strategic sourcing group to really maximize the dollar and everything that we're putting into the property. So it's just another way that a company like a JLL with the scale that we have can help those distressed properties.
Sam, I'm seeing from our perspective, I think borrowers can really benefit from a national or professional management company. I think what's hurt a lot of borrowers is their response or ability to respond to the decline in the market. How do you adjust to getting an LOI that's a couple of bucks less than you otherwise would have gotten or expected to see? And how do you adjust to having to pay additional TI? And it's invaluable to have an advisor, someone who lives the property with you on a day-to-day basis that could say, okay, here's what we're seeing here, here's what we're seeing there, and that's basically what you should do. And too often borrowers end up, and so Kevin, you see this, borrowers end up in a hole by making the wrong decision, and just to get to a level playing field where they could have the property recover vis-a-vis the market, they got to claw out of it.
Yeah, I think what we see, to your question, it's a combination of property specifics, market specifics, and borrower specifics. It's not usually one in isolation, it's a combination of those things. We use JLL on a lot of receivership and property management assignments where we have stepped in, as the special servicer representing the lender. And I think one of the biggest challenges to borrowers today is not that there aren't leases available to take up the vacant space, but because their basis is too high in the property, those leases are not economically viable for them. And so that basis either needs to get reset, either through a modification with the borrower, or the asset needs to transfer to the lender, or working through somebody like JLL, we can execute on leases, improve the occupancy, and stabilize the asset.
How are new lenders seeing this, if I may ask? How are new lenders looking at a property that's self-managed by a borrower that may not be a huge borrower, but let's say 10, 15 properties, versus working with a national company such as a JLL to be able to manage those properties? Do they give allowances for credit? Is that considered a credit enhancement per se?
I'm not sure it's a credit enhancement as much as if the person doesn't qualify enough with their experience, they're going to want a national firm to step in alongside them. If their track record, they could show their track record as a mom and pop owner manager, and they're able to deliver results, then it's fine. I think on the larger the property, though, where a lot of the tenants could be national tenants, then they will want to make sure you have some sort of exposure. Like we see on hotels, someone says at a hotel, I'm not on the regular reservation system. You have to find me by calling my hotel. A bank's not lending to that property. But I think it's really a newer borrower has an issue on a much larger property, and it's a lot more scrutiny. How are you going to deal with negotiating with some of these tenants? And the only way to compete is being able to buy economy to scale.